The recent sharp rise in gold prices may put pressure on these banks and lead to instability in any price-fixing arrangement. If the cartel unwinds, it could come quickly and violently. Do you remember the day you woke up? It was a Monday, and Lehman Brothers had gone under, and they were not going to bail them out. There would be winners and losers and potential contagion into other markets. In other words, the gold derivatives may become the epicenter of the next financial crisis, the next great crisis. In such an event, demand for physical gold would spike further, as would prices.
The start of 2025 has seen a robust performance in precious metals, with gold and silver leading the pack. Gold has surged by 12% and is poised to breach the $3,000 mark, while silver is edging towards new record highs. A significant driver behind the gold price surge is the mounting speculation about a potential revaluation of the U.S. government's gold holdings. These holdings, currently valued at the historical price of $42 per ounce, could be revalued to the current market value of nearly $3,000. Such a move could potentially bridge a substantial portion of the $1 trillion gap in the nation's balance sheet. If this revaluation materializes, it could trigger an immediate upsurge in gold prices. A physical gold shortage is becoming increasingly urgent, with the London Bullion Market Association, LBMA, at the heart of the global gold trade facing disruptions. As countries repatriate their gold reserves from institutions like the Bank of England, the London market has seen considerable strain. These movements are causing an imbalance, putting immediate upward pressure on gold prices. Recent geopolitical tensions have only exacerbated this issue, with rising demand for physical gold and massive flows of gold out of the UK and Europe. Renowned analyst Mike Maloney believes that this surge in demand for physical gold is creating significant logistical challenges, including price differentials between markets in the US and Europe. As concerns about gold security rise, similar to a bank run, many customers are accelerating their demand to withdraw their holdings. This intensifying demand could push prices even higher, further tightening the supply of physical gold. Meanwhile, many gold derivative contracts depend on securing physical collateral, and should this collateral become unavailable, the contracts could fail, potentially leading to a financial crisis. This underscores the value of holding physical gold as a more secure investment compared to exchange-traded funds or other financial products that may not guarantee immediate delivery. We present the clips of Mike's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
To shine in 2025 ends with some gold industry observers have argued that there is evidence that a handful of large banks that issue most of the gold derivatives contracts, derivatives, futures, forwards, leases from central banks, that's a derivative, GLD, SLV, those are derivatives. So that these large banks have acted in concert to manipulate the price of gold. An illegal pricing cartel among the banks would not be unprecedented. The public discovered similar practices in the mortgage-backed securities fraud leading up to the global financial crisis and in the manipulation of LIBOR, the interest rate at which banks lend to one another, uncovered a few years later. Now, you remember things like mortgage-backed securities, MBSs, collateralized debt obligations, CDOs. Those are derivatives. The recent sharp rise in gold prices may put pressure on these banks and lead to instability in any price-fixing arrangement. If the cartel unwinds, it could come quickly and violently. Do you remember the day you woke up? It was a Monday, and Lehman Brothers had gone under, and they were not going to bail them out. There would be winners and losers and potential contagion into other markets. In other words, the gold derivatives may become the epicenter of the next financial crisis, the next great crisis. In such an event, demand for physical gold would spike further, as would prices. No Sherlock. So, James Anderson asks, so where did all the Swiss to USA gold flow from? In January, the Swiss gold exports, so they're exporting to the United States, was 193.4 tons. Well, where it came from is the rest of the world sort of shut off. Actually, the rest of the world still had demand, but the Swiss gold refineries weren't selling to them. They were only selling to the United States. Look at this. China, 0.2 tons. The U.S., 193.4. Now, we are going to dig into this a lot deeper in a moment, but I want you to remember, China, 0.2 tons. Remember that. I'm going to dig into it. Got a couple of things we got to clear up first. This is the World Gold Council global mine production for gold. Here's the map. China, by far the world's largest gold producer, followed by Russia, Australia, Canada, and down here the United States. The China produces 2 1/3 times more gold than the United States. Remember that. Largest gold producer in the world. China secretly buys a large amount of gold, Goldman Sachs, 10 times more than official reports. So, this is Swiss gold imports. In other words, it's the people they are buying from. These bars are the people that are selling to the Swiss refineries. And what you see is the United Arab Emirates and the United States. And that's January of 23. February, the United States, Russia, Canada. March, United States, Russia, Canada. April, UAE and the United States. May, the United States. June, the United States. July, the United States. August, the United States. September, the United States. October, September is double counted here. So now these buttons get out of sync, these links. October. Nick, you're going to have to fix that someday. Sorry to put some extra work on you. October, United States. December, United States. Now we go down to March, United States and the UAE. April, the United States and the UAE. May, the UAE. June, the United States. July, the UAE. August, the UAE and the United States. September, the UAE. November, now the UAE. And I'm sorry, that was October. And November, the United Kingdom. So they're pulling a lot out of the UK. Now, we're going to go over to where they're exporting to, Swiss gold exports. And so we go back to January of 23, and it's going mostly to Turkey there. Now, what I want you to look at from now on, this bar of China, conspicuously present on the, absent on the supplying Swiss refineries, very present when it comes to taking from the Swiss refineries, buying from them. So I want you to pay attention to this bar and the United States here. The United States was the major supplier, and now China is going to be the major consumer from the Swiss refineries.
In his recent video, Mike Maloney underscores China's emergence as the world's largest producer and importer of gold. China strategically accumulates substantial reserves to bolster its economic position. By absorbing a significant portion of the world's gold, especially from Swiss refineries, China ensures a stable supply of gold and mitigates potential risks in its domestic market. The Shanghai Gold Exchange, renowned for its instant delivery and cash settlement system, plays a pivotal role in China's gold market. Any disruption in supply, such as a sudden gold shortage, could potentially trigger a global price spike and widespread panic. To avert this, China ensures its local refineries and gold shops remain well stocked, thereby avoiding potential instability. This ongoing gold accumulation enables China to secure favorable pricing, steer clear of sudden price hikes, and fortify its long-term position in the global economy. Furthermore, China's growing influence in the global gold market is also evident through its dealings with Switzerland and the United Kingdom. A large portion of the gold exported from Switzerland is directed to China, reflecting the country's increasing demand. Data reveals that more than half of the gold processed by Swiss refineries ends up in Chinese hands, strengthening its reserves and its global dominance in the gold market. Additionally, the increased movement of gold, particularly through COMEX warehouse deliveries, further underscores the intensifying demand for physical gold. China's approach to building its gold reserves quietly, without fully disclosing the extent of its holdings, positions the nation strategically ahead of potential global economic shifts.
China. Now, take a look at this. Here's China at 69 tons, the U.S. at 0.5. China is taking that month, China took 138 times more gold from Switzerland than the United States. That's March. April is very, very similar. May, China, India, the UK now needing gold in October. November of last year, the UK, there's a crisis is starting. November, India again. Now, that button was for December. It gives me November data. What happened to December? Well, I've got those because Nick Laird emails them to me. 64.5 tons, and China dropped down to just 4 tons. So China shutting off their purchases or being refused by the Swiss refineries so that the U.S. could get supplied. And then December, 193.4 tons going into the U.S., China at 0.2 tenths of 1 ton into China. Where did all this gold come from? It came from the rest of the world not getting any, and all the world's gold that's coming through the Swiss refineries going to the United States only. Now, what would happen in China if suddenly there wasn't any gold on the exchanges? You know, the Shanghai exchange is instant delivery. It's delivery the same day. It's a cash market, basically. And so if they couldn't deliver gold, there would be a panic and the price of gold would spike worldwide. If the shops that sell gold around China ran out of gold, there would be a giant spike in the price and it would set off a worldwide panic. So what is happening here? The world's largest gold producer and the world's largest gold importer that's just gobbling up most of the world's gold has gigantic reserves of gold that they're not telling us about, and they are probably now supplying, this is my theory, that they are probably now supplying the exchange and keeping all of the gold shops with inventory and so on. They're supplying the raw gold that all of the refiners and jewelry makers and everybody else uses so that there isn't a panic. Why would China do this? So that the price of gold remains low. They do not want gold up at $10,000 an ounce or even higher because of what it would cost. They're trying to accumulate enough gold to be on, when there's a monetary reset, which everybody seems to be getting ready for, then they want to be on some sort of level playing field at parity with the United States. They don't want he who owns the gold makes the rules. So this is Swiss gold exports for the entire year, 2024. Remember, 64.5 tons came from just December. So it was only 37 tons to the United States and 36, and 354.8. So basically, until December, it was running almost 10 to 1 there. And then let's take a look at UK imports. Where did the UK get its gold? It got it from Canada, the US, and Switzerland. Let's look at UK exports for 2024. China and Switzerland, and we know that more than half of the Swiss gold goes to China. And so the UK is selling it to Switzerland. You can cut off a little more than half this bar and stack it on top of that bar, and it's right off the top of the charts. That's where it's going. Look at how much went from the UK in 2024 to the US. And China really didn't start buying until, they weren't a big buyer back in like 1999. But you still have to take this Hong Kong bar, stack it on top of the China bar, and then take half of that Switzerland bar, so this bar is only up to like here, and pile it on top of this one. So basically, a bar almost this tall would be China. So it's China shutting off their demand, or the Swiss refineries refusing them. That's where all of that came from. But there's even more. Now,
the recent sharp rise in gold prices is putting significant pressure on banks involved in price-fixing arrangements, threatening to destabilize these systems. If the cartel that controls gold prices were to collapse, the fallout could be swift and dramatic, with winners and losers and the potential for contagion spreading to other markets. In such a scenario, gold derivatives could become the epicenter of a financial crisis, with investors scrambling to secure tangible gold assets amid fears that paper contracts may fail. This surge in demand for physical gold would likely drive prices even higher as supply becomes constrained and market uncertainty intensifies, creating a perfect storm of volatility that could escalate the crisis further. That's it for today. Share your thoughts on Mike's analysis of gold revaluation and price prediction in the comments section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos.